housing market is the hottest it has been since 2006, and it's got people using the B word, meaning bubble. Home prices hitting a record median price of $329,000 up for March, up 17% from March 2020. Supply coming in at 1.07 million homes for sale, representing just a 2-month supply of available homes. New listings selling on average in just 18 days, and that is a record pace. Consumer confidence, meantime, falling, with just 48% of consumers saying it is a good time to buy a house, according to Fannie Mae. Yet despite all of this, my next guest says he has a strong conviction that we are not in a housing bubble. Joining us now, Vishy Tirupattur, head of fixed income research at Morgan Stanley. Vishy, great to have you with us.
Thanks for having me. Great to be here.
What is missing from calling this a bubble? What is present in 2006 that we don't have today?
I think the key thing is the kind of mortgage credit. So if you look back to what happened in 2006 or the pre-crisis bubble, we had a large number of products that what we would call affordability products that characterized they had mortgage products that required home prices to keep going up, and the availability of credit continues to be very available. Those types of products accounted for over 40% of all mortgage finance that took place in that period. Those types of products are about 2% now. So much lower reliance on affordability products. So what we now have is a much more straightforward demand-supply situation. We have an enormous amount of demand coming from the millennial generation, coming up with a new rates of household formation. We just got some data that showed that the average rate of annual formations of new households is running at about 1.55 million new household formations. And that's the demand for shelter. The long-term average of that is about a million to 1.1 to 1.1 million is the new households that are formed. We are running at a much bigger number down relative to that. At the same time, as you just pointed out, there's just no supply. Right. In terms of the total supply, we are at an all-time low. Right. So supply low, demand high, prices are going to be good and on a strong, healthy foundation of a housing market that does not have the layers upon layers of mortgage risk that used to be there.
Right. People also have a lot of savings thanks to the pandemic, Vishy, and mortgage rates are low. What's your forecast for rates at this point? They seem to have settled down into this range here. And how important is that in the affordability component of this all? Housing prices can keep going higher as long as mortgage rates stay at bay.
Right. Our expectations at this point is 10-year Treasury at the end of the year at 1.7% is our current forecast. And unless market rates go much higher in a very dramatic fashion in a very short period of time, affordability will be fine. If mortgage rates go up by another 25, 30, 50 basis points, that doesn't dramatically alter the affordability scenario for home prices.
How should we think about the areas that have gained thanks to this dynamic and the areas that have lost in the pandemic? I mean, you read time and time again, particularly about New York City, that it's dead, and now we're reading that it's coming back. Can we have a city that's coming back on the real estate front when we still have this strong housing market in the suburbs? How should we start thinking about that dynamic?
I think there is some truth that there has been this migration from cities like New York and San Francisco into some of the outer suburbs, etc. But one thing you should keep in mind is that this migration that we have seen is also not too far away. It's not like people are leaving New York City and going to faraway states. They're still very much within commutable kind of a distance. And that's one point. The second point I would say is that even though the home prices in less densely populated suburbs have been faster than the, say, places densely populated large cities like New York City, we think this over time this will revert back. So I'm not going to say that as long as we have a continued demand for shelter and a lack of availability of supply, I am not going to say that there is a threat to the New York City real housing market.
Well, it's good to hear as a resident of New York City, Vishy. But I'm curious in terms of, the supply-demand dynamic. The supply issue is a supply issue because people during the pandemic wanted more space. So now that there's a reopening going on, how do you start thinking about that dynamic that's stressing the supply aspect of the equation going away?
Actually, the supply issue goes back not just simply from the pandemic. The lack of supply has been there for, you have to look back to last 10 plus years. And post financial crisis, we really have not built a lot of lot of homes, particularly single family homes. So we are in a very different plane of overall supply, not just over the last 1 year, but for quite some time now. So this is not just because of pandemic.
Sure, but there's a certain amount that has to revert back to pre-pandemic levels at some point, no?
It's a little bit of that, but we think that what we're simply saying here, not that home prices will continue appreciating at these double-digit rates. Pace of appreciation of home prices will slow. But what we are saying is that we are not in a bubble, the kind of bubble that we saw in 2006,
right?
2006, 2007, that led to the financial crisis. We are nowhere close to that type of a scenario.
Okay. Vishy, thanks so much for coming on. We appreciate it. Vishy Terapatur of Morgan Stanley. Tyler.